In the grand theater of finance, the final act is never truly a surprise, only the identity of those who find a seat on the last lifeboat. The story of Silicon Valley Bank is one such drama. In March 2023, a titan of the American banking world, the 16th largest bank in the nation, with over $200 billion in assets, vanished in less than 48 hours. The official narrative was written almost instantly, a simple, satisfying tale of executive greed, insider knowledge, and a rigged system where the rich got warnings while the small businesses and startups that formed the backbone of innovation were left to perish. But that story, as clean and convenient as it is, might just be a masterfully crafted distraction from a far more terrifying truth. Hello, and welcome to Us Financial Market Dynamics. Today, we invite you to listen to the story and join us as we analyze and decode every specific detail. To peel back the layers of the Silicon Valley Bank collapse and question everything you've been told. What if the so-called villains were not the architects of the disaster, but merely the first to see the floodwaters rising from a dam that was engineered to fail from the very beginning? What if their actions were not born of malice, but of a rational fear of a system that had become fundamentally unstable? The conventional story begins on March 10th, 2023, the day SVB officially collapsed, marking the second largest bank failure in American history. The narrative points its finger directly at a handful of key players. We are told about the CEO, Greg Becker, who sold $6 million of his own company's stock just 12 days before the institution he led turned to dust. We hear about the venture capitalists, the titans of tech like Peter Thiel's Founders Fund, who quietly advised their portfolio companies to pull their billions out long before the public smelled trouble. These actions are presented as the smoking gun, clear evidence of a conspiracy of the elite to save themselves while sacrificing everyone else. This narrative suggests that if only these insiders hadn't acted selfishly, if they hadn't triggered a panic, the bank might have survived. But let's apply a different lens to this sequence of events. Let's engage in reverse thinking. The story we are told is that the insiders' actions caused the bank run. But what if their actions were merely the effect of a much deeper, more fundamental problem that everyone, including the regulators, could see? To understand this, we must go back not just a few weeks before the collapse, but a few years to the era of the COVID-19 pandemic and the policy response that followed. Between 2020 and 2022, the Federal Reserve, in an attempt to stabilize a reeling economy, slashed interest rates to near zero and flooded the system with unprecedented amounts of money. For the tech sector, this was like pouring gasoline on a fire. Venture capital funding exploded. Startups, flush with cash they couldn't spend fast enough, deposited billions upon billions into their bank of choice. Silicon Valley Bank, SVB, was suddenly drowning in deposits. A bank cannot simply let that much cash sit idle in a vault. It must invest it to earn a return. But in a zero interest rate world, where could it possibly find a safe, stable yield? The answer, seemingly blessed by financial orthodoxy, was long-term government bonds and mortgage-backed securities. These were considered the safest assets on the planet. SVB purchased tens of billions of dollars worth of these bonds, locking in the paltry interest rates of the time. The mainstream story portrays this as a reckless gamble, a foolish bet that interest rates would stay low forever. But was it truly a bet, or was it a trap? In the economic environment created by the central bank, SVB's actions were not an outlier. They were the logical textbook response. They were doing precisely what any financial institution in their position was incentivized, and in many ways forced, to do. The real gamble wasn't made by Greg Becker in his boardroom. It was made by the Federal Reserve when it distorted the very fabric of the financial markets. CVB didn't choose to walk into the trap. The trap was the entire landscape. Then, in 2022, the script flipped to combat raging inflation, an inflation that was a direct consequence of the previous year's monetary policy. The Federal Reserve executed the most aggressive interest rate hiking cycle in 4 decades. Rates soared from near zero to over 5% in a breathtakingly short period. The laws of finance are unforgiving. When new bonds are suddenly paying 5%, the old bonds paying a mere 1% become drastically less valuable. The safest assets in the world held by SVB were now a toxic portfolio of unrealized losses. On paper, the bank was sitting on a $15 billion hole. This wasn't a secret, this wasn't hidden, non-public information. This was basic financial mathematics, visible to anyone who cared to look at SVB's public balance sheet and the Federal Reserve's public policy announcements. Federal regulators themselves examined SVB in late 2022 and saw the problem. They issued warnings. They knew. The venture capitalists, whose job it is to analyze risk, also knew. They could read the same financial statements. They understood what rising interest rates do to long-term bond portfolios. So when we look at Greg Becker's stock sale on February 27th, 2023, the reverse-thinking perspective doesn't ask, what secret did he know? It asks, why is anyone surprised he sold? The information about the bank's vulnerability wasn't privileged. It was public. The risk wasn't a hidden fraud. It was a glaring systemic risk created by monetary policy. Becker's lawyers claim it was a pre-planned trade, a Rule 10-to-5-1 plan. The common narrative dismisses this as a convenient excuse. But let's consider the alternative. Imagine you are the CEO of a company whose entire business model is threatened by a publicly announced government policy. Would you not, as a rational actor, seek to reduce your personal exposure? The timing seems suspicious only if we assume the collapse was a sudden, unpredictable event, but it wasn't. It was the slow, inevitable conclusion of a policy collision. The tragedy wasn't that Becker sold. The tragedy is that the system was built in such a way that his selling was the most logical thing for him to do. The same logic applies to the venture capitalists. The story of Peter Thiel's Founders Fund quietly telling its companies to withdraw their funds is often painted as the spark that lit the fuse of the bank run. It's portrayed as a secret, backroom deal that gave their circle an unfair advantage. But let's re-examine the nature of Silicon Valley. It's not a disparate collection of unrelated businesses. It's a tightly knit ecosystem built on information networks. VCs talk to each other. Founders share information on Slack channels and group chats. In this environment, the idea of containing critical financial information is an absurdity. Once, one sophisticated entity like Founders Fund analyzed the public data and concluded that SVB's risk was unacceptably high. That conclusion was destined to spread like wildfire. They weren't whispering a secret. They were the first to shout what everyone should have already known. The subsequent withdrawal of $42 billion in a single day wasn't a panic in the traditional sense of an irrational stampede based on a rumor. It was a perfectly rational, digitally accelerated response to a confirmed mathematical reality. The depositors weren't fleeing a shadow. They were fleeing a burning building whose fire alarms had been blaring for months. The unique nature of CVB's clientele, tech-savvy, highly concentrated, and digitally interconnected, meant that this rational response could be executed with unprecedented speed. A traditional bank with millions of smaller, disconnected depositors might have bled out over weeks. SVB hemorrhaged in hours. This speed isn't proof of a malicious conspiracy. It's a stark demonstration of how 21st century technology interacts with 20th century banking vulnerabilities. The insiders didn't have to conspire. They just had to act rationally on public information, and the network did the rest. This brings us to the aftermath, the bailout. The government, in an unprecedented move, stepped in to guarantee all deposits at SVB, far beyond the $250 FDIC insurance limit. The popular narrative frames this as the government rushing to save its wealthy, well-connected friends in Silicon Valley. It's seen as another example of socialism for the rich and capitalism for the poor. But what if the bailout had nothing to do with saving tech startups? What if the government wasn't looking at CB at all, but at the hundreds of other regional banks across America that they knew were sitting on the exact same time bomb? The unrealized losses on bond portfolios weren't unique to SVB. It was a systemic affliction. a direct cancer caused by the Fed's policy whiplash. The regulators knew that if they allowed CB's uninsured depositors to be wiped out, it would trigger a rational nationwide run on every other regional bank. Depositors everywhere would look at their local bank's balance sheet, see the same paper losses, and logically conclude their money was not safe. The failure to bail out SafeBB would not have been a lesson in moral hazard. It would have been the trigger for a systemic collapse dwarfing 2008. The bailout wasn't a choice to save the rich. It was a desperate, non-choice to prevent the entire system, a system of their own making, from vaporizing. The true story of CBB, then, is not one of individual greed. It is a story of systemic failure. The executives and VCs were not the villains who sank the ship. They were simply the passengers in first class who saw the iceberg first and had easier access to the lifeboats. The real culprit is the flawed architecture of the ship itself, designed and piloted by central planners who steered it directly into a predictable ice field. The investigations by the C and the lawsuits filed against the executives are, in this light, a form of political theater. They provide the public with a satisfying narrative and a cast of villains to blame. It diverts attention from the uncomfortable truth that our financial system is built on a foundation of managed interest rates and monetary interventions that create these booms and busts with predictable regularity. Charging Greg Becker with insider trading is easier than admitting that the Federal Reserve's policies created the very conditions for the bank's failure. It's a convenient scapegoat that allows the core problems to go unaddressed. The pattern is as old as finance itself. We see it in the 2008 crisis, where bank executives cashed out millions before the collapse of institutions like Lehman Brothers. Dick Fuld, CEO of Lehman, walked away with a fortune while the world burned. Was he a master criminal? Or was he too simply reacting to the undeniable rot in the subprime mortgage market that regulators and rating agencies had ignored or even encouraged? We see it in the dot-com bust of 2000, and even as far back as the crash of 1929. Insiders, those closest to the machine, are always the first to feel the vibrations when it's about to fly apart. Their actions of self-preservation are then retrospectively labeled as the cause of the crash, rather than a symptom of its inevitability. The system isn't rigged in the way most people think. It's not about a secret society passing notes in a dark room. It's rigged because the very rules of the game, set by central authorities, create predictable cycles of instability. And in any unstable system, those with the most information and the fastest reaction times will always come out ahead. The real scandal isn't that some people got out early. The real scandal is that the system is designed to require such frantic escapes in the first place. And here is the truly chilling climax of this revised story. The SVB collapse was contained. A bailout was issued. The public was told the crisis was over. But the underlying condition has not been treated. Regional banks across America are still sitting on billions in unrealized losses. Commercial real estate loans are beginning to sour, adding another layer of stress. And what are we seeing? We are seeing the exact same pattern. A quiet, steady stream of stock sales by executives at these other vulnerable banks, all dutifully filed with the SEC, all hidden in plain sight. This isn't a prediction of doom. It is an observation of a pattern. The insiders are once again moving first. The so-called smart money is repositioning itself. The story of CB was not an anomaly. It was a dress rehearsal. It was a warning shot that most people misinterpreted. We were told to look at the actions of a few individuals, to debate the ethics of their stock sales and the fairness of the bailout. But we were looking in the wrong direction. The real truth of the Silicon Valley Bank collapse is that it exposed the fundamental fragility of a financial system built on the sand of artificial interest rates. It revealed that when the tide of monetary policy goes out, we see who has been swimming naked. The insiders were not the cause of the problem. Their actions were a clear signal that the problem was already terminal. They were the canaries in the coal mine. And by focusing our anger on the canaries, we ignore the poisonous gas filling the entire mine. The question we should be asking is not whether Greg Becker should return his $6 million. The question is, what happens when the next larger bank begins to wobble, and the government, already burdened by monumental debt, finds itself unable or unwilling to fund the next bailout. The pattern doesn't lie, history doesn't repeat itself, but human behavior in the face of flawed incentives is remarkably consistent. The insiders didn't break the system. They simply played the game according to the rules they were given. They played it better than anyone else. The real tragedy is that the game itself is designed to periodically self-destruct, and when it does, the architects of that game are never the ones who pay the price. This video analyzes historical economic cycles and current indicators for educational purposes, not financial investment advice. Please consult a professional before making an investment decision. If you enjoyed listening to the story, please press like, share this video, and leave a comment with your opinion. Don't forget to subscribe to the US Financial Market Dynamics channel and hit the notification bell so you don't miss any new videos.